Welcome to Private Equity Solutions. My name is Ferdinand Ruano, CEO of PES. We're here to share with you information about the Private Placement Memorandum, or PPM as we call it. The PPM, the origin of PPM was to introduce a different concept, a different alternative investment for a portfolio that is traditionally filled with stocks, bonds, money market, annuities. So we try to build and construct a different portfolio, a different model of investment that will enhance the returns and lower the risk. And we did it using distressed assets, especially mortgage and real estate, income properties or flip properties. We construct a portfolio since 2010. We have been doing this. The average return has been between 24-25%, triple net. Triple net means after commissions, legal cost, any rehab cost. So we calculate everything in the cost basis. And after we get that, we subtract the gains, and the gains we divide it by the total amount of investment. The average share has been between 24-25. No question about it that our PPM does better when we got recessions, when we are in distress, because then we can buy 20, 25, 30 cents in the dollar. What we did is that we create a fund using some methodology and some systems that we built since 2010 to flip the properties quicker and earn more, using creative financing, using owner financing, using lease to own, different concepts that we use in order to increase the velocity of the portfolio. The PPM was created to give you the alternative to participate in an investment like that. Usually requires $250,000, and you have to be you gotta have a net worth of $1 million. But basically what we did is we made it more affordable, easier to participate to the investor that has some wealth, but needs to invest money in something different than stocks, bonds, and cash. So we construct a fund using the same principles of the real estate investing that we use. We buy income properties, we rent them, we flip them. Some of them we have owner financing on them, but we construct it so it can be diversified. So you are not only subject to the gain or loss of one property. We got several properties. So you automatically, by investing in the fund, you earn diversification, potential growth, fixed income, principal stability, and collateral. So you are guaranteed your principal and your investment for 5 years. You earn 8% annual investment. You can reinvest those dividends, or you can just get payouts. You don't have to reinvest it. You are not obligated to do that. You got every 90 days windows of liquidation, so you can withdraw the money every 90 days, March 30th, June 30th, September 30th, December the 31st. So they have some liquidity. We use a protocol of distribution of 90 days in case that the person needs to get his money back. There is no surrender charges like most contracts they have in the market. That they have in mortgages is prepayment penalty. In investments is surrender charges. We don't have any of those two. We made it affordable for the people with a $10,000 initial investment. The idea was to give us a try. If you're skeptical about the returns of how we perform, you lose $10,000 is not that much of a deal for most of our investors. So it's a somewhat to give you a trial, so you can experiment and experience the opportunity to invest in the fund. Currently, the offering is up to $50 million. We're halfway there. We are accepting new investors. We're open for the markets. Of course, there is a process that we use to qualify you. But the benefits of the program are diversification, some liquidity, principal guarantee with real estate, income at 8%. And there is a bonus at the end of 5 years that you can earn an additional 10% bonus of the investment that you have with us, the contribution that you did, plus any interest earned, it will earn an additional 10% bonus at the end of 5 years. Of course, if you got all the dividends and you receive the dividends, well, the bonus will be applied only to the amount that is left in the fund. But we feel very comfortable with the concept. We applied in my own money before I really start creating the fund for other people. We have a collateral of $1 for every investor. It means that if you invest $1, we have a collateral in real estate or mortgages of $1. That's why we can secure the principal. And basically, I will say that the private placement is the core of the other different systems that we use. I call it the PPM the easiest way and the most liquid way to invest. Similar to a traditional investment, even it doesn't work like a traditional investment because we use real estate and we use different techniques in order to enhance returns and diminish the risk. So, in a nutshell, I believe that the PPM will be a great opportunity for an investor that qualifies under the Section 506, which means that it's an accredited investor. It has to be accredited, and that's by the law, by the SEC law. It's called 506. That it has a person that has to have an annual income of $200,000 if it's individual. If it's a joint, it's $300,000. We have to make sure that the person is a income earner consistent in that area, in that range, or $1 million of net worth excluding the principal residence. That's what the law says. Then you have institutions and all that. But for most, this video is directed to the people that are looking for an alternative for a different type of investment, and they can earn some additional rate of returns with such a low fixed income that we're getting and with the volatility of the market. So if you don't like volatility, if you want to earn more than a 2% certificate of deposit or basically tie up your money in a government bond for 10 years, 12 years and earn 2%, and you're looking for a different alternative, this can be a great alternative to really diversify your portfolio. And probably one of the question that I get from most of the clients is how much of my portfolio should be allocated in something like this. The studies say that if you look Harvard, Yale, the endowment funds, they're using between 20 to 25% diversification in what is called an alternative asset. This is an alternative asset. So the answer, between 20 and 25% of your portfolio probably will increase your return and diminish your risk in a long period of time, in a time horizon of 5 to 6 years. So we're going to have a web page that basically will have additional information. The regulations requires that we provide additional information. It's called a prospectus or a memorandum with all the details that will be available for you. And we're looking forward to really have it. If you have questions, inquiries through our website or through our telephones, I will be more than glad to take care of you and explain you without any sales pressure, without any attachment that you have to make a commitment because I get involved in the process. We are here to serve you, and we want to make sure that you make an informed decision because it's your future, it's your money, and I have been there. I am an investor too, so I know how you should be treated. So I'm looking forward to hear from you, and we are here to help you. Thank you so much.